Graphic dimensions, which includes everybody, with the current youth bust, youth thrust, which was also referred to in the discussion this morning. You find that the challenge for development enhances or covers all the other parts of the population, but also particularly the youth, the youth factor. Now, this development dimension or demographic dimension was further enhanced in 2015 through the United Nations Convention, which adopted the 2030 agenda for SDGs, and this became broadly encountered or embraced by all other countries and so forth. And then for African Union, you find that at the same time they adopted the 2063 agenda for inclusivity and the socio-economic development. And that was the start of a collective effort in the midst of Africa, particularly the African nations, to try to see if the development process itself creates this general perception of benefits for all. Nobody is left behind, and everybody benefits from the development aspects. If you go to the next slide, you will see that the policy thrust of inclusivity, has four main agenda items. One is the income growth, which is covers the main aspect. People have to increase their incomes. Traders, beneficiaries, industrials have to increase their income. And that is the way in which one can say there is a way of including everybody by including income. The next one is social development. Social development, that is on the right. Social development includes everybody. You have health, education, and all other health aspects, which while those are developed equally to everybody, you find that everybody is included in the development process. The third one is productivity. Productivity, it means you enhance your capacity to be able to sustain your development effort. That capacity is enhanced by industrialists, enhanced by traders, enhanced by academicians, enhanced by farmers, and enhanced by the youth. Productivity enhancement encourages or provides the space to benefit, for everybody to benefit from the process of inclusivity. The last one, which has been of late development agenda, a very effective development agenda, is infrastructure. Infrastructure has been everywhere now. In order, as income grows, you find there is an increasing need to develop infrastructure, roads, railway systems, airlines, and so forth, in order to be able to cover everybody and to provide everybody with the sufficient space to be able to increase their productivity and to increase their participation in the demographic dividends. If you go to the next one, we will see that as we pursue this process or the policy of inclusivity, you find that with the youth bulge, the population of the youth, you remember President Kikwete this morning said that the population of Tanzania, for example, it has an average of 19 years. Now that 19 years is only the youth. Now, as the population of the youth increases, you find there is a need for all actors to make sure that the economic benefits arising from and for beneficial of the youth is increasing over time. So all African countries try as much as possible to make sure that the youth benefit from the economic activities or the benefits of economic activities for the financing aspect and so forth. But you find that in order to do that, the countries have to enhance or to increase their long-term development finance, and particularly to broaden the internal or the domestic financial systems, so that once you broaden and you deepen the domestic financial system, it opens the room for or other actors to be able to benefit, because it's easier for many actors to access internal financing structures than to access global financing structures like multilateral development banks, institutions, or official development assistance, and so forth. But the internal one, the domestic financial systems, is the key which can be able to broaden or sharpen these demographic dividends. Now, let's look at the benefits which so far we can count on. Some examples, 10 examples. Of late, there have been some discussions and there have been some research and so forth outputs which says that if you look at the countries which has, let's say, have the benefit of increasing incomes, there are basically 10 countries in Africa. And these are South Africa, Egypt, Nigeria, Kenya, Morocco, Mauritius, Ethiopia, Ghana, Tanzania, and Angola. I repeat again: South Africa, Egypt, Nigeria, Kenya, Morocco, Mauritius, Ethiopia, Ghana, Tanzania, and Angola. Those are the 10 countries which have been able to demonstrate that the income growth out of financing and the development has been quite visible. Now let's look at the key aspect of those development dividends which have come up from the team. Next page, please. Yes, you see here, this chart demonstrates the number of millionaires. Number of millionaires of those 10 countries, yeah, including Tanzania. You see South Africa has over quite a large number of millionaires, over 39,000 millionaires, followed by Egypt with 16,000, and then Nigeria with about 10,000, Kenya about 85, Morocco 5,000, Mauritius 4.8, Ethiopia 2.9, Ghana 2.9, and the Tanzania 2.4, and the Angola 2.4. Those are the millionaires. Looking at the incomes level, the success which this development and the financial infrastructure has been able to generate. We have generated millionaires in Africa, and those are the group of millionaires. Can we go to the next page? That is one aspect of demographic dividends. Okay, let's go. As GDP per capita, which is the second aspect of income growth, you will see the highest of GDP per capita is Mauritius. That is in the center there, almost to the right. And the others are much lower than Mauritius. South Africa is also much lower than South Africa. Tanzania is also much lower. You know the numbers of Tanzania is 1,080, and the others are a little bit higher, and so forth. So you could see the first one of millionaires, we have quite a large number of millionaires, but not so much large because those are numbers of people, 2,000, 3,000, 4,000, 28,000. In the population of 40 million, 60 million, and so it's not a large number of millionaires. So now for GDP per capita, you see it's 1,000.8, 2,000, 3,000, and so forth, dollars per person. Now let's see the next stage of no, we are still on the same page. Sorry, yes. The graphic, sorry, it doesn't show very quickly, but this shows on the poverty head count. In the earlier discussion, there was also a discussion on poverty head counts. Poverty head counts now comes on to the people, how many people are left out in this development process, how many people they did not get this demographic dimension, demographic benefits, and so forth. How many people are those? You will see the highest, with the highest number is, unfortunately, is Tanzania, followed by Nigeria, followed by Kenya, and followed by Ethiopia and Angola, and so forth. You'll find Egypt has the lowest, Morocco and Mauritius has the lowest. Those 3 countries have the lowest. But the rest of the countries, and that could be spread over the rest of Africa, that the demographic benefits is not yet there. So the development dimension still requires a lot of effort in order to be able to generate the development dimensions which is required for Africa, which was perceived by our head of state, our head of the father of the nation, that everybody must be included in our development effort, inclusivity. Now, the next aspect which we should look at is pursuit for graduation from LDC. We know most of the African countries are LDC category, and therefore you find that a large number of these countries are facing a lot of challenges in order to be able to develop. One of the challenges is low incomes. We have seen that the low incomes, GDP per capita, and so forth, and is very low. And you find you have the social character, the social dimension, which was the second aspect of this demographic, the demographic benefits, dividends. The social aspect of health and so is also remaining a lot of challenge. And then you have extreme levels of underfinancing for development. So when you have not sufficient levels of financing for development, you cannot expect that those dividends will occur as quickly and as evident as envisaged. And therefore, you find that even it was also mentioned in earlier discussion that even the donors, the development agencies, their supply of resources was inadequate, has been inadequate. To many countries, not only to Tanzania, but to many African countries, has been inadequate, not responding to the requirements which was required to be able to generate those demographic dividends. So if you go to the next one, you find that pursuit for graduation still leaves a lot of space. You find in the health sector, you have development gaps of 7.9%, education 12.1%, social protection 21%, and also the new elements of biodiversity, the climate effect. You still have a huge aspect of that one. Now, we have seen that we have huge development aspect to be able to tackle for Africa, and therefore going back to the money aspect, which Professor Mkandala mentioned this morning, where does the money come from and how do we get the money to be transmitted to be able to provide the development aspect we are looking for. So in pursuit for the transparent inclusivity and the graduation from LDC status, many countries need significant financing to close the development and infrastructure gaps, also meet the SDGs, and also be able to sustain the demographic dividends. The continent itself, African continent, has huge potential to be able to attract those development needs or development aspects, because we have a young and growing population, which provides a lot of future aspects of investment. We have abundant natural resources, which was also mentioned by Governor Luoga this morning. We have large markets. Africa is a huge large market, and the population which is growing at a very fast rate has just a promise of becoming a huge, possibly the largest market in the world. And also, we still have a great potential for digital transformation. Now, with those aspects, which are key resources to be able to to provide our countries and the resources for development, you find that we can see what has happened. Until the 1990s in Africa, African countries financed their development through two main aspects of financing. One was domestic resource mobilization, which was also in detail clustered by Governor Luoga. The second was external concessional loans. Now, the external concessional loans, which is very important because of the factor which happened later, was, thank you. The external concessional loans in most of African countries were provided by the Paris Club of Nations, that is official bilateral donors, which was provided under concessional and standardized form. And the second aspect was provided by international financial institutions, the multilateral development banks, which is like the World Bank, the IMF, and also the regional development bank like the African Development Bank, and so on and so forth. So the benefits of these, the advantage of these resources, financial resources, was that they were of low interest rates, and they were of less conditionalities, and they were also given a sufficient timeline for countries to be able to start repayment systems. If you go to the next page, you find that if borrowing from commercial sources, which was also an open stage in those early days of our development process, was that it also took the form of syndicated commercial bank loans, which syndicated, it means that these are formal, transparent loans which the beneficiaries also negotiate properly with those loans. And also suppliers' credits. When you are buying commodities and products from suppliers, they can either give it to you on credit or you just pay by cash. So these commercial loans were also structured in the sense that beneficiaries were also involved in the formulation of these lending instruments. Now, that notwithstanding, you find that in the medium term, because of the development needs of our countries, the push for development, the push for to be able to provide the additional resources and the additional benefits to our countries, you find that the demands for these resources were quite a lot, and they came in quite a lot. But also the capacity to be able to service these loans were constrained. And because of those constraints, you find that countries were lagging behind in their payment system. Huge debts were accumulating. And as was also stated earlier, our father of the nation was also responsible for participating in the promotion of debt relief, which we all benefited in the early hours of 20 years ago. So the HIPC process, that is the process which provided the debt relief for the highly indebted countries, provided space for these countries to be able to offset those resources, those loans which had been accumulating over time when the countries were having a hard time to repay, in order to be able to provide them with new space for them to be able to borrow concessionally, and the development path to be able to keep on increasing their development resources. So with that process of the HIPC, which provided that space, still the countries expanded their fiscal consolidation domestically, and they also expanded the financial system in order to be able to provide the required finances for countries to be able to increase their development. That was a benefit for most of the countries, and most of the countries, you see, Africa had the highest population, had the highest economic growth. Most of the countries had the highest economic growth compared to Europe, and except for Russia, Asia. But for Europe and Latin America, you find that Africa had the best performance on that one. Now, in parallel to that, multilateral development banks also provided a lot of resources. In addition to providing these debt relief facilities, but also they provided a lot of resources in order to be able to push the development dimension in Africa as such. The MDBs provided more equity financing and the local currency financing also for those which were could do that, and also other risk sharing instruments, because they had that mandate to be able to provide those resources. So these financing instruments helped our countries to be able to reduce the dominance of high-risk financing instruments, particularly from the other foreign financiers. Now you find that one of the missing link here, which is missing still, is the private sector credit financing from outside. it's still missing. It has been missing for most of the years until when it came into the late 1920s, 2020s. Its development, private sector development financing started emerging. Now, the private sector development financing, the landscape has changed a lot. You remember previously they were also under those debt instruments which are basically controlled by the multilateral development banking institutions, and therefore they were providing instruments which the beneficiaries were comfortable with, although the debt levels were going up. Now with the landscape of these private creditors growing up, becoming so huge, it's a huge market in the global economy, you find that it has changed the domestic debt levels in our countries, or even the content of the debt has changed a lot, as countries now are accessing these instruments in order to be able to finance most of these challenging development projects, particularly in infrastructure and the others which are quite challenging. They are accessing these private sector credit institutions, and in the end, we'll see what is happening. So the number of creditors and the diversity of lending instruments have changed rapidly, including bond financing with many instruments which have complex structures. These have complex structures and also have variable interest rates, uncontrolled interest rates, and also acceleration clauses, which over time, the determinants of those contracts and the programs change over time. So, and some of these instruments, they become tradables. They become tradables in our markets, and also in the regional markets, also in the external markets. So once those loans become tradables, you find the beneficiary, the borrowing beneficiary has lost controls over the trend and the content of that lending instrument. Can we change the next one? So what has happened, therefore, is that in the medium term, in the African countries, you find that the domestic debt levels, external debt levels has increased quite rapidly. Although you find the ODA, as it was mentioned earlier, ODA has not been increasing rapidly. The ODA was responsible for increasing our debt levels in the 60s and 70s, so that we went to debt relief efforts, which was HIPIC. But now ODA levels have not been increasing so rapidly, except the private sector, the private creditor institutions and the debt, those have been increasing so rapidly. And as I said, you find the interest rates are variable and the other conditionalities are variable. And what has happened was that now the medium debt to GDP level has increased rapidly in many countries. And that has raised a lot of issues, which a lot of constraints for many of the countries, in the sense that as these debt levels increase, you find that the capacity of countries to hold the additional debt is reduced. And also they become, as we shall see a little bit later, you find that the outstanding debts become a little bit unbearable, both to the other participants in the global economy, but also to mostly to our economies as such. Additionally, you find that there are new elements which have come into the field which need financing, and this is climate-related issues. Climate-related issues has a lot of benefits, yes, to invest in climate issues. You find that you invest in climate-resistant infrastructure, you maintain climate-resistant agriculture, irrigation, you invest in seed varieties, and so forth. But as you strengthen your capacity, your productivity capacities, by investing in these new areas of climate resistance infrastructure, climate resistance irrigations, climate resistance agro systems, you find that you need a lot of resources in order to be able to do that. Now, to be able to do that, you still have to go back to the market. Either you go to the internal market, which my colleague from the Development Bank will also mention the benefits and the constraints there, but also you still go to the external markets to see if you can get those additional credits. Now, as I mentioned, private sector participation in lending to our countries has created a lot of constraints, and therefore we are now seeing a number of issues which are new, is debt vulnerabilities. We had 10, 15 years ago, HIPIC, which was related to official lending. Now we have debt vulnerabilities, which is not related to official lending, but mainly related to private sector lending. And this one, you find that as 2 years ago, there was an assessment of the position of countries in Africa on the level of lending, of the borrowing. And it was seen that a growing number of countries have been able to, the growing number of countries have gone into a high risk of countries. If you can go to the next one. Yes, this one. This one you see, this is the last slide. You will see the first two captions on the slide is expressing the risks involved. You see in 2015, that is the first one, is 2015, you had only 8 countries in Africa which had a high risk of external debt. Only 2015, 6 countries. Now, today, that's the last one. The last one, you have 2021 or 22. You have 20 countries which are classified as high-risk borrowers, and that is unsustainable debt. And mostly this is unsustainable debt which is lent to our private sector lenders. Now, for countries which have involved, which have been classified as to be on the high risk, I think you are aware of those in Africa, those about 20 countries, including Burundi, Cape Verde, Cameroon, Central Africa. Fortunately, Tanzania is not yet there. And now, with that, Mr. Chairman, if you allow me, let me conclude. I have a few elements which I should mention here. One is that Africa economic population growth, which includes youth bulge, needed to be fully supported in order to translate into a sustainable demographic dividend, so that that dividend is sustained, needed to be continuously supported. The second is that many African countries need significant financing to close the development and infrastructure gaps, and also meet the SDGs and sustain these demographic dividends. Number 3, the MDBs, the World Bank, IMF, and the ADBs, and so forth, should continue to provide the needed and the appropriate financial support to African countries in order to be able to sustain the development content. In parallel, access to long-term finance in parallel to access to long-term finance, which is external, we need to deepen the domestic financial systems and infrastructure, so that the large part of the development aspect is funded by the local finances. Lastly, our government should work effectively with the MDBs and also other development partners in order to be able to reduce the vulnerabilities which I've mentioned here, to reduce the vulnerabilities of external debt as soon as possible, so that our countries can sustain the development efforts and also benefit all other aspects, and also be able to have a sustainable inclusivity, which was overseen, which was foreseen by our father of the nation, President Nyerere. Thank you very much.
Thank you very much, Dr. Ahmed Ndyeshobola. We now have the next presentation is by Dr. Joseph Ochieng Witz. He's going to is from CRDB. He represents the managing director of CRDB, who has to travel to Kagera today. And so Dr. Witz has been chief commercial officer of CRDB until very recently. Karibu sana, Dr. Witz.
Good afternoon. Thank you, Chair. Mine is going to be very brief, taking advantage of the coverage, the wide coverage that the governor made this morning. He kind of covered almost everything that I wanted to cover. So that leaves me with just a room to talk on practical experience on what exactly banks do in terms of development of this country. So I've actually structured next. I've structured the presentation to cover 4 main areas as guided, covering roles of banks in Tanzania in resource mobilization. I will also cover instruments that banks use towards resource mobilization, bank success in resource mobilization, deployment and impact, because that has to be seen, and the role of banks in increasing the pace of equitable development, and that is mainly the main theme of this session. So getting to now the practical part of it, I'll start by saying that resource mobilization is the key function of banks in whatever that they do. Theirs is the intermediation. They bring together all the stakeholders, all the players in the market, and so that they're able to channel the resources from the deficit spenders to the excess spending units. So in a way, what banks have done, if I am to just enumerate, is establishment of a network of over 900 banks so far that are operating in Tanzania. We have developed digital financial channels accessible to many customers to facilitate 24/7 transactions happening through different channels, name it ATMs, mobile banking, internet banking, agent banking, wakala out there. So banks have done incredibly well in terms of making financial services accessible to majority or a large number of Tanzanians. Developed numerous savings products, because how do you get to customers or to the people out there so that you are able to get resources into the banking system? You have to go with a product that convinces them. So this is developing numerous savings products to attract deposits from different markets, and those products has to be market or segment specific with incentives to different sectors. If you go to farmers, you have to go with a product that appeals to farmers. If you go to students, you have to go with a product that appeals to students so that we are able to attract deposits from students. And banks also does one noble role of financial literacy, training and awareness to a large number of Tanzanians, be it in schools, be it in different forums like we are now doing here. But we do that to impart skills and make everyone aware of the availability of the financial products and services, and for them to have like a saving behavior so that they are able to bring in resources into the mainstream banking towards the development of the economy. And also, development of the human capital has been one factor that banks have done, and that boils down to the human capital that works with banks. They have to be developed so that they are able to handle the sophistication that is being brought by technology for them to be able to, for banks to be able to manage. And the second part is the instruments that banks use in the mobilization of resources. So I'm taking Next. Yeah, that is the same. I'm taking an example of where a bank starts from the scratch. So the bank itself will have to go through an initial public offer that it appeals to the public for share investment. And that brings in the first resource that banks use towards investment. So that will be shares, and that will come in as a resource from the public. And that can also come when you go to the same shareholders through rights issue. That is also one of the instruments that banks can use to source resources from the shareholders. But another famous resource instrument is depository accounts that banks use, current savings account, fixed or interest-bearing time deposit accounts to bring in resources or savings that people have out there, out of the savings that they have made. But we also have special products. Banks have developed special products that appeals to diasporas that they are able to bring in money through different incentive schemes that we attach to those products. And also of recent, we understand that TIRA made it mandatory that banks operate bank assurance, meaning that all the bank branches countrywide are now mandated to collect insurance premium towards insurance of various insurance categories. But that is, has really made it now wide that many Tanzanians can now access insurance as a financial product, but also it becomes a source of resource mobilization from the public to the mainstream banking. But also retail and corporate bonds are also some of the products that banks use in the resource mobilization. And that has fared quite well. When companies wishes to raise money, or the big corporations, they go through banks and they're able to raise resources from the public. Or when banks on their own wishes to raise deposits, they would bring some incentives onto the bonds, and those would attract savings that are held by the public. And also banks have special schemes that attract grants, and that there are special arrangements that they bring grants, and bank channels those grants to the specified areas where those development partners have also a common shared interest. In the interest of time, Chair, I will go straight to the next. Banks accessing resource mobilization. There has been a lot that has been achieved in terms of being able to do the intermediation role, bringing together the deficit spenders together with excess spenders, and make sense out of what each has. So what we are saying, the bank has supported the country to reduce dependence on donor countries, just out of resource mobilization. And that has enabled us to finance our country's budget and uphold and protect our sovereignty through resource mobilization, because as earlier discussants have said, a country that has no resources that can support its budget will have little to do or to say on determining their destiny. You will find a number of other or donor countries deciding quite a number of even internal affairs for you. But if you are able to generate your own resources internally, you will be able to plan how to use them and finance your internal budget, and hence you will not be a beggar that now subscribes to all the conditionalities that the donor countries usually give. And we have recorded as a country numerous successes in the following key performance indicators. We've opened bank accounts to 29 million Tanzanians. That is quite a lot. Raised over 40 trillion in total assets. If you take total assets that banks hold in the entire market, it's over 40 trillion shillings. And we've raised 27 trillion in deposits from the public. That is excess savings that banks are holding in trust for the public. And we have raised over 6 trillion in capital, the capital that all the banks in this country are running on. These are resources that we have collected from the public, and these are used to run the banks that are in this country. We've established a wide distribution network of over 900 branches. We count these as achievements, and increased domestic savings as a percentage of gross domestic product from minus 0.6 to 34% in 2021. This is a great achievement that we now have more than what we use, as opposed to other countries that are still trading on a negative gross domestic savings. We have, as banks, banking community, implemented technology-based collaborations and integrations that have now opened up this country to the international financial systems. And as the governor alluded, we are able to effect online transactions the world over. It takes a matter of minutes to have a transfer or any banking transaction effected. It does not take weeks and months as it used to do in the last years. But that did not go without challenges. We've had a number of challenges in two different areas, both on the demand and on the supply side. Just to mention a few, the low financial literacy. There are a lot that has been done in this area, but we still feel that much still needs to be done in the financial literacy area. Irregular income pattern, and this is, so to speak, the poverty level is still high. That affects the resource mobilization initiatives or efforts that banks are making. Financial information asymmetry in decision making. There isn't a common database where we can draw data or information for decision making. So the decisions that banks make, or even the governments and make, are not coming from the central database. You find some are outdated as 5 years backwards, but they're still used towards making decisions. And low saving culture. So these are still issues that government and all the stakeholders need to work on. But on the supply side, affordability has been an issue. Much has been done. Cost is going down, but it is still not where it should be. So it's also something that is scaring people, much as we are saying the level of savings is low, or resource mobilization is low, but it's also being caused by cost and accessibility, much as automation has been done. Automation has been done, and we are connected. Banks are integrated with almost all the systems, private companies, government institutions, like TRA for tax collections, MNOs for money transfers, but still there are limitations in terms of the outreach. Not every Tanzanian has been reached with the financial services. Limitations in some products and services in meeting. Not all products addresses the real needs that people have out there. And so those are a few areas where we think if efforts are geared towards addressing this, we could be counting achievements in the next few years. In terms of success, Chair, we have recorded a number of successes. Also, in lending, as we stand now, you have over 22 trillion shillings that banks in the country have lent out that are supporting real economic activities in the market. And this is quite a significant amount if you take as a percentage of the GDP. So that really is, we count that as a big success that banks have been able to make. And we, as banks, we give a lot of contributions in terms of grants to the government and to the society, and corporate social responsibilities that addresses most of the social needs in the health, education, and environment. And that we really count that as a contribution towards the development. Next. Also on the impact from the bank's resource mobilization and deployment, that yes, there are different numerous interventions that are being done, but what is it that is the real impact that all these interventions have brought into the economy? Financial system stability, I think that is number one, that you have a stable financial system that is well regulated, that is well developed, and that assures that all the financial transactions that are being carried out in a country are going seamlessly, and there isn't any havoc as we see in other countries. So there is an unhindered flow of resources from excess spending to deficit spending units. Enhanced financial inclusion, we are not yet there as per the statistics that the governor gave in the morning. We are still not yet there, but at least a lot has been done, much as now we are, the matter is now differentiating that how many do we have in the formal financial mainstream, how many do we have in the unilateral systems, that at least we have quite a number of Tanzanians that now can access financial services. And we are boasting of banks being able to facilitate government revenue collections. We have integrated with government tax collection machineries, and we are able to collect taxes from every corner of the country, be it through internet banking, be it through agent banking, be it through our mobile banking, be it through branches. The banks are boasting of being almost everywhere for the government's revenue collections, and that has really increased the level of resource mobilization. So we count that as a massive impact. On the economic growth, everyone has said that you cannot leave a bank behind when you are talking of economic development. Banks are doing a massive role in support the growth of the economy. Attainment of a lower middle income category in 2020, the banks cannot be left behind. We've played quite a pivotal role to make that happen, and we were there early enough before the 2025 goal that was set for the country. But also the GDP growth from 4.2 billion from those days in 1990 to $62.4 billion as per 2020 World Bank report is quite a massive achievement, and banks feel to be part of the contribution. So we count that as an impact that our intervention as banks have been able to bring. But also job creation. When you have an economy developing and the rate of unemployment being reduced from 3.6 in 1991 to 2.2, even with the increasing number of population, but you are still able to increase the rate of unemployment. That is quite a massive achievement. And these are World Bank statistics, and we are really proud of being part of this achievement. But improved social well-being of communities is a goal of everyone. The government would like to have to see its citizens living quite decent life, and banks stood in between to make sure that the government realizes this noble objective. And reduction of social inequality has been a major challenge as enshrined in the different policies that the government has issued, and we are seeing this happening in different areas, and we are part, banks claim a part of it. Chair, going with the time, I'll cover the last part of the presentation of the slide that takes account of now how, on the equitability, that how would banks ensure that there is an equitable development and sharing of the resources. I've covered a number of different national policies that have been promulgated from time to time in different sectors of the economy where the requirement for equitable distribution of resources has been made a mandatory. And the banks have also taken note of all these, and we have developed programs that addresses this. For example, in the National Environmental Policy of 1997, that requires equitable use of resources for meeting of the basic needs of the present and the future generations without degrading of the environment or risking health or safety. Banks have developed credit management policies that do not allow financing of any project that is not environmentally friendly. And that is a requirement, and that even the central bank usually would review if a commercial bank finances a project that is not environmentally certified by the respective authority, NEMC, or if it does not bear environmental assessment, impact assessment. So the banks would make sure that that is done. On the National Sustainable Industries Development, there is an emphasis that equitable development and environmental stability. So that is also taken care by that very credit policy requirement that banks should not finance projects that are not environmentally friendly. Also, when you go to Zanzibar, there is a Zanzibar agricultural sector policy that requires women to have equitable access to and control over productive resources. So banks, we have developed women-centered financial products and services that have concessionary interest rates, preference, and even in terms of security, we have relaxed conditions for women accessing loans. And this is just to make sure that we are supporting government initiatives to make sure that women have access to financing so that they are able to realize their dreams. And on education and training policy, there is a requirement on equitable distribution of educational institutions and the resources. And in this, banks have a special preference for financing of education institutions. And you would find that I don't think if there is a single education institution that has no funding from a bank or of any kind. If there is no funding in terms of loans, but we have grants, we have CSR activities that are happening around different educational institutions, just to make sure that we really help to achieve the government to achieve long-term development objectives. On equitable development and the management of the nation's water resources, we have implemented technologies that support efficient utilization of water and energy. And this is at respective workplaces. You remember this, we've said banks have 900 branches all over. So if banks have policies that are OSHA compliant, you would find them operating with technologies that support efficient utilization of water and energy at different offices. And now with this large number of branches, there is a lot that can be gained in terms of from the savings. And on the mainstreaming environment into the Zanzibar second national water for growth and reduction of poverty that requires equitable pro-poor growth. And here we have the same interventions that we use to support like having CSR activities. The banks are almost everywhere trying to finance, helping even government's own initiatives, and we are there almost everywhere. Mr. Chair, with this, I really would like to end by giving a quotation that the father of the nation once gave, that a man is developing himself when he grows or ends enough to provide decent conditions for himself and his family. He is not being developed if someone else gives him these things. This is a book that Mwalimu wrote in 1973. And this really boils down to the point that if a country needs to develop, it has to have systems, means, mechanisms to mobilize resources that it can use to develop its own development agenda. So thank you, Chair. And
Thank you very much, Dr. Witz. I think some of our students might now be attracted to your banking. Thank you. Now we are going to change gears and move on to trade as an engine of growth. And Dr. Mmari, Executive Director of REPOA, will make the last presentation. Karibu, Doctor.
Thank you very much, Chair, and also the Chairperson of Board of Directors of REPOA. It's too bad to be last when people are already tired, but I'll try to be as brief as possible. Please move to the next slide. I will only intervene on 3 areas. Trade as an engine of development, prospects for increasing trade, African trade, and issues around competitiveness. Next. Indeed, I would like to argue that trade can be the engine of development, and the evidence is that countries with higher shares of world trade also tend to have higher shares of per capita incomes. And you can see clearly on that diagram there, Africa's population of around 16% of the world population contributes only 2.9% of GDP and only 2.6% of world trade. When you compare with Europe, which is a population of around 10%, contributing nearly 35% of GDP and close to 20% of world trade. And similarly, I mean, that's America. And Europe, with a population of close to 10% or less, contributing to about 25% of global GDP and nearly 40% of world trade. And similarly, Asia contributes to a much larger proportion. The population would have been much smaller if you exclude India and China, but they contribute quite significantly to the global economy and trade. And if you look at the African per capita GDP, which is about $1,843, which is almost 81% lower than the world average of $10,000. And you see that there's only 25 countries in Africa above the African averages, and only 2 has per capita income above global average. And these are Mauritius and Equatorial Guinea. And you know why Equatorial Guinea? Rich in natural resource. Seychelles, sorry. Seychelles and Equatorial Guinea. So Africa have not been able to take advantage of trade, which indeed has propelled development in other continents. Next, please. But while the share of Africa's in world trade is low, the shares of trade to African GDP remains very, very high. Based on the estimates from the World Bank, Sub-Saharan Africa share of trade to its GDP is 53%, compared to 30% for North America and 39% for South Asia. And if you look at the data, between 2000 and 2017, that's a mistake, 2007, the Africa's share of exports to the rest of the world, not within Africa, ranged between 80 to 90% of their total exports. And these have made Africa quite vulnerable in terms of the global demand and supply shocks. We have experienced recently the impact of COVID-19. We experienced the impact of different weather vulnerabilities. If Brazil coffee booms, African coffee prices drops. But if the Brazilian coffee production increases during good weather, we cannot compete. and similarly now Vietnam. So African coffee prices goes up only when there's frost, only when there's bad weather that affects the rest of the world. So we do not determine global prices, even of commodities that we export. The geopolitics, we know what is happening now in Europe with the war between Russia and Ukraine. The supply chain scarcities have caused prices to go up of things that we import, not necessarily of things that we export. So the terms of trade have deteriorated. Next. When you look at the African intra-regional trade, it's much lower when you compare to other regions. Intra-regional trade within Europe, within the Americas, in the NAFTA agreement zone, is quite high. There are signs of growth within in the intra-African trade, but it started from very low base. And if you look at the patterns of trade, they appear to be shifting. More trade of intermediate goods, including exports within the region, suggesting that we are gradually upgrading within the value chain. But that is more between African and Asian markets. We also see gradual shift of trade in capital and intermediate goods, also with the East Asian. It is important to diversify our export base from mainly exporting primary goods to also exporting manufactured or semi-manufactured goods. But there are some risks. We have seen increasing protectionism and trade war among the major economies, United States and China, the impact of Brexit, the trade agreements among themselves, but also the impact of the fourth industrial revolution, which has tended to increase efficiency, global production, and trade, but it may actually affect the trajectory of industrial development in the world. We had expected that industrial transformation will grow when production will be shifting from East Asia, particularly those that are labor intensive. But this trajectory may change because of the innovations and technology that has been brought by the fourth industrial revolution. Next, please. But is there prospects for increasing African trade? Yes, there are. We need to integrate more into the world economy, which is really important for the African economic growth. But this will require African countries to upgrade their goods through value additions so that we can capture more value out of the products or the commodities that we produce. If you look at the data from UNCTAD, shows that the primary commodity exports were 56% of Africans' exports. This is quite large. And you know what? The value of primary commodities is much low compared with the commodities and goods that are industrially produced, which we import. And therefore, the terms of trade for Africa continues to deteriorate. And also our products tend to concentrate in few markets and few types of more generic commodities that have to change. We have to improve trade efficiency by reviewing our policies, trade and industrial policies, improving our logistics, and reviewing our tariff structure so that they can encourage more export-oriented production. Next, please. We have to develop a strategic diversification of our products and markets by deepening intra-regional integration. We're talking about CFTA, regional economic cooperation, and so forth, and effectively utilize the existing preferential agreements between Africa and the United States, AGOA, and others that some governments are still negotiating. We need to insert more strategically in the global value chains to increase exports of intermediate goods and to increase more importation of intermediate goods and capital goods that enables African countries to produce exportable commodities. There are some evidence of increasing participation in global value chains, and these are visible in Mauritius, Lesotho, Eswatini, Tanzania, Ethiopia, and Kenya. But we need to do a lot more. We need to implement policies that will help African economies to increase productive capacities of local firms by adopting technologies, innovation and standards, and this can be supported by integration into global value chains. And obviously, Africa needs to strengthen institutions to enforce contractual obligations and international standards that can help us to enhance participation of its firms in the downstream end of these global value chains. And that will require definitely increasing trade competitiveness in Africa, which is my next slide, please. I said initially that there are some signs of export diversification in Africa, but at a much lower pace. And we need to increase the pace of productivity in Africa and competitiveness so that we can fast track the diversification and competitiveness of African trade. Opportunities do exist for increasing trade competitiveness in Africa through the Continental Free Trade Area. Many countries have ratified, but the protocols for implementation are still to be put in place. Effective utilization of preferential trade agreements between Africa and the rest of the world, and taking advantages of manufacturing offshoring. Some companies are already shifting some production bases. Recently, I visited some of the firms in Tanzania, in Arusha. We found them actually making garments for exports, branded for the companies, such as Calvin Klein, etc. But we need more of those in the region. What do we need to do with that? We need to improve quality and to reduce cost of trade in services, because services are becoming increasingly more important for manufacturing. Services such as banking, my friend Dr. Witz explained in detail the role that banks have played and will continue to play, insurance, energy, legal services, and so forth, which are very important. Nearly 20 to 30 or even 40% of manufacturing costs today are service related and not labor, not necessarily capital, not necessarily raw materials. We need policy coherence among state actors in terms of agencies, regulatory agencies, ministries, ministries of industry, agriculture, energy, trade policies, tax policies. They have to speak to each other to enable domestic manufacturing firms to become productive. We need to strengthen non-tariff barriers, streamlining non-tariff barriers within the regional economic communities, such as harmonization of rules, such as the rules of origin. Some countries apply them differently, and this becomes quite significant non-tariff barriers to producers. And we also need to reduce cross-border trade costs within Africa by implementing and undertaking significant investments in trade, logistics, and infrastructure. Next slide, which is last but one. As African countries, we need to collectively engage with global leaders to address imbalances in global trade governance. For example, there are some instances where the technical barriers of trade, which are applied unfairly, treated differently for commodities that come from Africa or Europe or America. That includes sanitary and phytosanitary measures that tends to be quite complex and difficult for African producers to comprehend. And countries need to embed in institutional innovations and implement selective industrial policies that can help our producers to raise productivity and to be able to compete in the key productive sectors. Some specific public investments to reduce externalities and coordination failures, and to implement temporary fiscal measures that are needed for strategic subsectors or activities within these sectors. So to conclude, Chair, indeed, trade remains an important driver of economic growth and development in Africa. Diversification is important in terms of product and market concentration. We need to increase trade in intermediate goods and high-value goods and services, but this requires effective and strategic integration in global value chains which can enhance local productive capacities, and of course to increase intra-regional African trade so that we can reduce exposure to shocks, which we have seen recently, and implement selective industrial policies, which will definitely require very strong political will and capable institutions. Thank you very much for your attention, and let's take action now.
Thank you very much, Nana. Yeah, asante sana. Okay, ladies and gentlemen, we've heard our three panelists. They've all been very eloquent in command of the subject matter. So we'll now take in comments and questions, if any. Karibuni. Yes, please. Mheshimiwa Balile. Okay, go on. We should introduce yourself briefly, please.
Thank you so much, Mr. Chair. My name is Deodatus Balile. I'm the chairperson for Tanzania Editors Forum and the member of the task force. I thank the presenters for eloquent presentations, and I have one question for the bankers. I think Dr. Witz is representing them. In most developed economies, banks are investing in ideas. But in Tanzania, we are investing in going concerns. Startups are rarely accessing loans from the banks. What incubating or incubation mechanism you have in place to make sure you help those who are coming to the business instead of letting them remain spectators?
Thank you very much. The question? Yes, please.
Thank you very much, Cephas, once again. My question and goes to Dr. Ahmed Ndyeshobola. You are painting a picture, unless I didn't get you well, to mean that population increase, or what you're referring to as demographic dividend, is a factor to either economic growth of Africa as a continent. Of course, basing on the current population, which is almost 1.4 billion people. But I'm asking, what if this population actually puts pressure on either governments to be able to feed its population? Wouldn't, in a way, population increase, or what you're referring to as democratic dividend, a liability rather than an asset? Thank you so much.
Okay, thank you. Yes, Bio, Professor.
Thank you very much indeed, Chair. And thank you to the presenters. I would like to direct this question to the two presentations on finance, Dr. Witz and the first presenter of this panel. Looking at the Tanzanian banking system, what proportion of your lending goes to the productive sectors of the economy beyond small and medium enterprises, SMEs? How do you support the real economy? In comparative perspective, if we look at the pattern across the African continent, it has been much easier for banks to support services and trading as opposed to industrial manufacturing investment. And what can we do to correct this imbalance, to encourage banks to be more long-term in their focus as opposed to short-term in their pursuit of interest? Thank you.
Okay, thank you. Any other? Yes, please.
Hello, my name is Daniel Mugizi. I work for Haki Elimu. I just had a question about the most recent presentation. I think earlier it had been said that the average age for Tanzanians is around 19 years old, which would mean basically the average Tanzanian is going into the workplace now, and unless they're maybe going to college. So I wanted to ask, what do you think would be the most beneficial skill that the average Tanzanian should have now that would be able to help them to take advantage of some of the opportunities here and being able to provide competitive goods and services in Africa?
Thank you. Yes, please. Yeah, I'll come back, yeah.
Thank you. My name is Joshua Lukonge from the Department of Economics. I direct my question to the last presenter, Dr. Donald Mmari, when he was talking about improving the African Intra trade. He spoke of some of the things which needs to be improved or upgraded so that we can be better on that. And he spoke of the legal issues, etc., etc. There is one which was left out, and I was wondering if it was left out on purpose or otherwise, and that is the currency issue, the monetary union. Now, pertaining to the monetary union, there are two people. You can group the people in two groups. There are pessimists and optimists. The pessimists, in the sense that they don't believe if the currency will be viable and to be helpful and productive, and the optimists who believe that the East African currency, the East African Monetary Union, will be viable and helpful. I fall on the former group. I am a pessimist. Now I was wondering, what's your take on the East African currency union? Do you think it will be viable in any manner? Thank you.
Thank you. Yes.
My name is Julius Busungu, Deputy Secretary General of AUDITORIUM. I've got two questions. The first question is concerned to Dr. Donald Mmari. Actually, he talked about what we call trade competitiveness. I haven't heard anything about how can price and quality affect the competitiveness of trade in Africa. And the second question is about the intra-African trade. Most of the African countries deal with commodities like agricultural goods which are not processed. And how can they fare to reduce the exposure to shocks where the world actually is concerned about finished products?
Thank you very much. Yes.
Okay, my name is George Chalale. Okay, I'm a PhD student from education. Yeah, my question goes direct to REPOA, Executive Donald Mmari. You're talking about the framework, but when you are speaking about the policy of education, you take the policy of 1995. Why there is the current one, which is 2014?
Okay. Any other questions? Okay, so we'll let our panelists then respond. We'll start with the last one. Ninavyosema Biblia bwana. Wa kwanza atakuwa mwisho kwa kwanza. Dr. Mmari.
Thank you, Prof. I would in the same vein, I would like to start with the last question, but I didn't understand it very well. Did you speak about education policy? Well, I don't recall to make reference to education policy. I was speaking about industrial policy. And industrial policy here, I mean the practice of selective interventions, selective policy actions that are needed to debottleneck a particular sector that is an important driver of growth. That's what I was talking about. I'm sorry if you mistook it to the education policy. Unless you have asked about different questions, we can discuss. Then, from my friend there from AUDITORIUM, you asked about agricultural commodities. How can they be competitive, if I understood you correctly? I think even commodities are commodities. Even if they are primary commodities, you need to be able to differentiate your commodities by quality, but you also must be able to compete by making sure that your productivity is high so that the cost per unit is lower so you can compete in the market. And a good example is the coffee. In 1980, the data shows that Tanzania was exporting about 1,200,000 bags of coffee. In that same year, Vietnam was exporting only 70,000 bags of coffee. Only about 29 years later, Vietnam already was exporting 3 million bags of coffee, and Tanzania had regressed back to 700,000 bags of coffee. And we could no longer compete in that mainstream coffee market. Why? Because of our quality deteriorated when our cooperatives ceased to operate. So the farmers did not have the sufficient support systems and mechanism to enhance their coffee quality. We lost that market. And now we can no longer compete in the mainstream market. We have to seek for specialty coffee markets. So it is indeed the same case applies even to agricultural commodities because the globe is not stagnant. Your first question was about inequality, if I understood correctly. Yes, if you don't trade properly to meet the global standards, you can be outcompeted, and trade can actually propagate inequality. If you cannot meet the standards that are required by the market, then your farmers can actually, the terms of trade between urban and rural and between developed economies and African countries has also deteriorated over time, and therefore has tended to exacerbate inequality as well. On the legal issue, I spoke about the importance of policy reforms. Policy reforms would include monetary policy. You asked specifically about the East African currency. I think we should be aware that learning from even European Monetary Union, it took several years before, they started with the common markets, then the customs union, then the monetary union came much later. You really have to strengthen first the fundamentals of the economy. Because as soon as you go into single currency, as a single country, you lose your monetary policy tools, and sometimes even fiscal policy tools that you can actually regulate and adjust to your economy as different shocks ensue. So it's something that we have to yes, in the long term, it's beneficial, but those issues that are fundamental to the economy that requires subsidiarity has to be put in place first before you actually rush to a common currency. The issue of, that's the last question for me, about the average age and the skills. Obviously, the young people need technical skills, so that we can become more productive in all sectors. We need soft skills to be able to understand opportunities, markets. We need basic life skills that can help us to transform the knowledge and learning that we get from various levels of schooling, from primary school, secondary school, and university, to convert them into the economic opportunities or productive activities, either in self-employment or in employment in various formal sectors. So I think those are key. That wasn't really a subject of the discussion, but we can find some time to discuss the issues of skills. Thanks.
Thank you very much. Dr. Witz.
Thank you, Chair. I had two questions directed to me, or to banks for that matter. One was from Mr. Balile regarding banks investing in ideas in some places, but here he kind of sees banks investing in businesses that are already operational. I think that is to a certain extent maybe true and not true to a certain extent, because banks, it depends on how you profile, how you are actually profiled by banks. So we have numerous interventions that banks make. We have segmented our customers in micro entrepreneurs, those that would require even a capital of as low as 500,000, as low as 1 million shillings. Those actually, we have special windows in different banks that handles such small size of customers. And it's not easy. It's not something that you can go out and say that you have a special window that everyone can come. There are numerous challenges as listed of trying to mold and make these into bankable customers. So in a way, we have them, and banks are still burning their fingers in terms of non-performing loans in the type of customers that are still at the low base. So we are developing them, but you find a large number of customers are upgraded and become bankable, and these are the ones that you see coming into MSMEs, coming into SMEs, and we are graduating them until they become small corporates. But any person that has a bankable idea who comes to a bank and presents his idea, many banks that I know in the market are able to help. If you have anything specific, you can come to one of the officers here. Maybe we have NBC, NMB, we have CRDB here. They can talk to you as an individual. Second, a question that came on the role that banks play in financing agriculture, and the professor who had asked the question had wanted to know in terms of percentage, if how much do we really direct towards the manufacturing sector. What I can say, there is so far literal in terms of percentage, less than 20%, and that is also combining working capital and investment capital. We have very literal long-term funding, because when you talk of manufacturing, you would be asking for 10, 15, 20-year loan. That cannot really be handled by the local banks. Well, for whatever little that we've been able to do at the local level has been through syndication, that we are able to join hands with international banks that we are collaborating with and be able to offer. Maybe we play a lead bank role and are able to arrange for such financing. But otherwise, if you ever try, then you will cause a mismatch between your funding structure. We have the maturity of our funding ranges between a maximum of 1 or 2 years. That is what we can get from the market. The market is still shallow. We do not have the latitude of sitting on long-term funding. If you are to finance a long-term project, you must also have a matching arrangement where we also go outside and also borrow long-term. And those we are doing. If you have a pre-arranged facility, you go borrow and you match. But otherwise, from own funding that we arrange from the local market, you cannot support a large ticket of loans from our own internal sources.
Asante sana, Dr. Ahmed.
Yes, thank you, sir. Is it working? Yeah. There was a question regarding the demographic dividends, with the fact that if population growth is too fast and it becomes a liability, what are the options open for the country? I think that is correct. The question is correct in the sense that if you look at the issue of China for the past 20 years, the 20, 30 years, 40 years, they have been quite sensitive on their population growth in order to be able to contain that growth and not to make it a negative dividend. But in the case of Africa, African population is still a little bit relatively lower than the other countries, the other regions or the other continents. Although the forecast is very optimistic that in the next 20 years, Africa's population will be larger than China, but less than India. And possibly in the next 60, 70 years, African population will be much larger than any other continent in the world. And therefore, one has to be sensitive that there is a possibility that the current demographic dividends which we are foreseeing may not be long-lasting if the population growth is projected at that rate. And therefore, what one could do is, and one could advise the governments and the other responsible authorities within each country, is that to be able to oversee the appropriate level of population growth. And there are a lot of instruments in which can be applied in order to contain that population growth. But on the other side is that population growth which is being forecasted is also done on a positive note, that the African market is going to grow quite fast compared to the rest of the global economies. And therefore, most of the producers, suppliers in America, in Europe, and also in China will be dependent on the African markets. And if that is the case, one might still see the positivity of that population growth and see that demographic dividends being a real dividends in the long term. But one has to assess those elements from time to time to see what is the most preferred or most valuable option going forward. The last question was, I can't remember the person who asked the question, but it was about Africa, why there was no clear choice for financing services instead of manufacturing. I think the choice is related to a number of countries. Some countries can easily choose to finance services quite easily than manufacturing. But others who have less opportunity to promote service sectors, mainly because of the structure of the economies, you would find that they would prefer to go in the value addition kind of production processes and the productivity increases, rather than to go to the service sector, which they have limited competence and limited content economically to be able to. for countries like Tanzania, which have a huge service sector, potential huge service sector, yes, we have that choice to go for financing the service sector as such. And many other countries in the neighborhood, like Uganda, Kenya, Rwanda, even in Southern Africa, they have a huge potential for the service sector. But even you go to countries, let's say in the Sahel, in the West Africa, their service sector is extremely limited, and therefore for them, the choice would be mostly to go to the value addition sector in order to increase the productivity in the agriculture and also manufacturing. So the choice is not quite evident to everybody, but there are that choices which can be made. Thanks. Thanks, Chair.
Thank you very much. Please let's put our hands together again for our panelists. Asante sana. Any announcements?
Thank you very much, panelists and the chair. And on behalf of Kigoda himself and the entire team, we really are appreciative of your presence here. Thank you for staying till 6:30. That means what was said today from early in the morning to today was very important and meaningful for Africa and for Tanzania. So therefore, I would like to say thank you, and let's hope to be here again tomorrow at 9 o'clock so we can continue to discuss, to debate, and to talk of the futures of Africa and Tanzania in general. Karibuni sana, asanteni sana,